Right now, there is this absolutely profound mystery hiding in plain sight. We are literally living in a moment where two completely different economic realities are coexisting at the exact same time. It's a tale of staggering wealth, a struggling middle class, and a historic transfer of risk that you really need to be aware of. Think about this glaring contradiction for a second. The stock market recently hit its 23rd record high this year. By the numbers, we're looking at one of the richest moments in human history. But consumer sentiment toward the economy? It has fallen to its lowest level ever recorded. I'm talking lower than the 2008 global financial crisis and lower than the pandemic lockdowns. So how can the data show a booming economy while the average person feels completely broke? Okay, let's dive into this. On one side, we've got Economy 1. Here, paper wealth is just skyrocketing, and the average 401k just hit a record high of over $160,000. It looks absolutely fantastic on paper. But then we have to look at Economy 2, which is basically a survival crisis. A record 6% of savers are raiding their retirement accounts early, literally eating the penalty fees just to get cash. And 36% of those hardship withdrawals, they're simply to avoid foreclosure or eviction. So forget about that old K-shaped recovery we used to talk about. What we are actually living in right now is an E-shaped economy. Picture a stick figure letter E in your head. That top bar stretches way out, capturing all the wealth. The bottom bar sits trapped on the floor. And that middle bar, it's tilting downwards, migrating away from premium grocery stores and sliding toward discount retailers, just trying to get by. Because here's the thing, asset inflation isn't like weather. It doesn't just fall on everyone evenly. The trillions of dollars created when the market climbs land in very specific accounts belonging to specific people. The top 10% of households own roughly 87% of all stocks. Meanwhile, the bottom 50% of the country, we're talking about the nurses, teachers, and bus drivers, making up 67 million households, they're fighting for just a combined 1% of the market. And this brilliantly illustrates exactly what I mean. Let's look at the actual dollars. The median stock holding for the bottom half is only about $13,000, while the top 10% sits around $600,000. So when the market returns 16% in a year, it hands the wealthy a staggering $96,000 paper gain. But for the bottom half, that same booming market hands them a mere $2,000. The participation got democratized, sure, but the dollars never did. So if the bottom half isn't riding the stock market wave, what exactly are they riding? Well, debt, and brutally expensive debt at that. Americans are now carrying about $1.25 trillion in credit card debt, and the average interest rate on these cards is a crushing 23%. And people aren't financing luxury vacations here. They are taking on what experts are now calling survival debt. A quarter of buy now, pay later users are literally financing their groceries. They are splitting a trip for basic food into 4 payments just to eat. Because of this, the bottom 50% of the country actually has a negative savings rate, meaning they are sinking deeper into the hole every single month. So bringing all this together leads us to one massive, glaring paradox. If the average consumer's finances look this grim, and they are tapped out with survival debt, who exactly is enthusiastically funding the explosive, multi-trillion-dollar AI stock boom we're seeing in the markets today? Well, the answer brings us to the AI Dine and Dash. Look, in finance, every single trade requires a counterparty. If you are buying, someone else out there has to be selling. Right now, highly informed founders and venture capitalists are selling their shares. They're capitalizing on profound information asymmetry. Basically, they know the internal numbers that we don't see, and they've decided they would rather have your cash than their own stock. Why are they sprinting for the exit like this? Because they understand a basic mathematical trap called net present value, or NPV. Think of NPV as a time traveler's price tag. It takes all the cash a project will supposedly make way out in the future and translates it into today's dollars. It's a brilliant mental model, really, because if the NPV is negative, the smart money rejects the project instantly because it mathematically destroys value. And let me tell you, when the smart money runs the NPV math on AI, the numbers are absolutely staggering. Big tech is currently projected to spend an astronomical $725 billion on AI infrastructure in the year 2026 alone. To put that into perspective, that is a spend of $23,000 every single second. Now match that incredible spending against the actual money coming in. Over the last 12 months, the entire AI economy has generated just $110 billion in revenue. That is a massive shortfall between what is flowing out to build the tech and what the tech is actually earning back from customers. When you do the math on that $725 billion infrastructure spend versus the $110 billion in revenue, it yields a disastrously low return of just 15%. This means the immense capital being deployed right now is generating only a fraction of what is actually needed to justify those sky-high valuations we see in the headlines. So, the crucial point is, when companies actually try to use this tech in the real world, 95% of corporate AI rollouts are producing absolutely zero measurable return. Only 5% show any measurable financial benefit at all. When the most informed investors in the room see a gap this huge between the hype and the actual revenue, they don't wait around. They initiate the dash. And the crazy part is, you don't even need to be a Wall Street insider to see this happening. You can spot the dash yourself. Literally, open your own investing app and check the shareholding pattern. It's kind of like a secret feature on your phone. If you see the promoters, the founders and insiders quietly dropping their shares, while the retail category of everyday investors is climbing, the handoff of risk is happening right in front of your eyes. You can even dig a little deeper into the market depth on your app. Look at the ask price versus the bid price. In these heavily hyped companies, you'll often see situations where 70% of the market volume is listed by people desperately trying to sell at the ask price, but blind optimism from retail buyers just continues to pump the stock price up anyway. Seriously, ignore the 84% buy ratings you see from financial analysts. You have to look at the actual financials. When a company like OpenAI is projected to lose $38.5 billion in a single year, while simultaneously being valued at an astonishing 65 times its revenue, the fundamental math of investing has officially left the building. Let's move to and see how this builds over time, because history shows us that this exact handoff of risk repeats itself right before every historic bubble pops. From the dot-com IPOs in 1999 to massive insider exits in 2007 to the SPAC craze of 2021 and now the AI dash today, the playbook is literally always the same. And we really have to remember the serious carnage left behind when retail investors are left holding the bag. Real people lost their life savings in these events. Of the tech IPOs in 1999, only 29% even survived the next 10 years. And those everyday investors who bought into the 2021 SPAC blank check craze, they suffered an average loss of 67%. The insiders got rich, the public got crushed. Or just look back at the real estate bubble. In June 2007, right at the absolute peak of the market, the founders of Blackstone took their company public and personally grabbed $2.6 billion in cash. Shortly after they secured their exit, the global financial crisis hit, and that stock plummeted 90%. They knew exactly when to walk away. It perfectly echoes that infamous 2007 quote from the former CEO of Citigroup, "As long as the music is playing, you've got to get up and dance." Imagine a room full of insiders passing around a scorching hot potato. They know the music is going to cut out. They just want to make absolutely sure they've handed that potato to someone else before it does. Right now, today, that hot potato is the AI stock market. The smart money clearly sees that prices have sprinted miles and miles ahead of the actual business fundamentals. And so, they are enthusiastically handing off that massive risk, which is priced for a perfection that simply doesn't exist, straight to the public. So what does this all mean for us? How do you actually protect yourself? Well, you have to read the room. First, ignore the media hype. Second, watch the insiders selling on your investment apps. If the founders are running, take note. And third, always look for the NPV math. Check if that astronomical spending is actually generating real-world revenue. Because at the end of the day, when you're looking at an economy where everyday people are having to finance their groceries, yet tech stocks are at record highs driven by insider selling, you have to ask yourself, are you truly buying the future, or are you just paying for their exit? Thank you for watching this explainer. Stay curious and always look at the numbers they want you to ignore.